Good morning, everybody, and welcome to the third part in our three-part series. This is Options Advanced. Today, we will be going over a couple of advanced strategies. Before we do that, let me pull up our slides. A little bit of administrative stuff, which I will mention again at the end of the session, but I want to get it out of the way at the beginning too. This will be the last session for a little bit. We are putting the option series on hold while we renovate. So I'm going to go through the option series. I'm going to take in all the feedback that I have received from all of our subscribers who have been attending. It's been great feedback. If you want, please send me more feedback. And in a couple of months, we are going to then re-release this series again as a rotating series. I think we're going to go to 5 parts instead of 3. So we'll make it a little more gradations in there, and I think it's going to be better for everybody in the long run, which is the goal. So this is going to be the last in our series. We will not have a basic course next week, and all of the previous sessions are available. They're in our archives. I'll show you at the end of today's session how to find those to go through them. So what we want to do today is we're going to talk about some advanced strategies. All right. This is what we are looking at today. Ooh. So if anybody wants a copy of these slides, I'm happy to send them out. Just send an email into support@chaikinanalytics.com. We're not actually going to go through a ton of slides. I'd rather spend more time. Feedback I've been getting is you want more time on the platform, but you like the slides to have to reference. So we're incorporating that feedback as best we can. Before we get into any of this, all this is for educational purposes only, is not considered to be advice or recommendations to trade. A little bit about me. Enough about me. We're going to talk about calendar spreads, ratio spreads, straddles, and strangles. I haven't gotten a lot of feedback on the ratio stuff, so we're not going to spend a ton of time on ratios today. We'll go through it. If you have any questions, let me know. I'm happy to take time and pause and go through it. But it seems to be that more people are doing calendar spreads, and I've gotten some questions on straddles, less on strangles, a little bit on straddles. So we'll go through those. We'll spend a little more time on those. All right, and we'll talk a little bit. I've been talking about calendar diagonals. We'll talk a little bit about pure calendar spreads also and the difference today. There is a Q&A window. There's also a chat window. If you have anything, please, questions in. Right. All right, so let's rock and roll. A calendar spread is where we buy a long dated option and then we sell a short dated option against it. Now, most of the people that I talk to are doing what's known as a diagonal calendar spread. So the difference between a diagonal calendar spread and I guess a regular calendar spread is a regular calendar spread uses the same strikes. A diagonal calendar spread uses different strikes. Right? A calendar spread really just means we're taking 2 different expirations. So anytime you have a trade where there are multiple expirations involved, that is a form of calendar spread. We talked about vertical spreads last week, where you're on the same expiration and different strikes. A typical calendar spread, a textbook calendar spread, is same strikes, different expirations. But as I mentioned before, what really I see a lot of people doing is different strikes and different expirations. And I've been operating under the assumption that that's what most people are doing. But I have gotten some questions on regular calendar spreads, so I want to go over that too. Okay, so different time frames. What we're trying to do is take advantage of a directional move. These are typically debit-based trades. I guess in theory you could do them for credits, but I don't know anybody who does. These are debit-based trades, which means any debit-based trades, we want a lower implied volatility environment. I spoke about implied volatility last week. We want to look at implied volatility not at the upper end of the implied volatility range for long calendar spreads. Just about any long debit strategy, we want low implied volatility, and this is no different. And now, the way that we set these up can be out of the money, in the money. We could do these. A calendar spread could be you buy the monthly and then sell the weekly. Could be you buy the quarterly and sell the weekly. It could be you buy the leap and sell the quarterly. Could be you buy the leap and sell the weekly. And that's a lot, right? But it's just any difference in expirations. Typically, the ones that I talk to people about, they're buying a little bit farther out in time. Most of them are doing leaps. You don't have to do leaps. But the idea is to take advantage of a bigger, longer move over the duration of the debit leg, and at the same time use the credit leg to chip away at the premium that you paid out to lower your cost basis, just like we do in a vertical. Except in a calendar spread, we're going to attempt to sell multiple times against it. So what we might do is buy, maybe next January, and you can see how long ago we started this series, because I was looking 227 days away when I pulled this, is now only 18 days away. All right. And think about where the S&P is now. This is an example on the SPY. But you could buy the leap and then sell the monthlies. And that's what a lot of people that I know do. Now, when I set these up, I like to do it where the difference between the strikes is greater than the total initial cost. So I'm going to write that out. So ideally, we want the premium paid to be less than initial premium paid. Well, you're only going to pay the premium the first time, and then you're going to start receiving it. But we want the premium paid to be less than the width of the initial strikes. What do I mean by that? Well, the premium we paid here is about $1,000, right? $1,068 in premium. The width of our strikes is 10. So if we were looking up here, we would say the premium paid is 10.68. And that is not less than the width of our initial strikes, which is only 10. Now, you don't have to do it this way. I think that it puts you in a better position. It's like a good golf stance or baseball stance. It makes it easier to hit the ball right? So doesn't guarantee success. I think it's another little bit of odds in your favor. And all of this is about having the risk reward that is good for us, and odds, and that equation is how it works. how often you're right versus how much you make versus how much you lose. And the more we can stack the odds in our favor, the better off we are. So this is one way to do it. Now, when you go deeper in the money, it makes this easier, okay, with the debit leg. The credit leg, let's talk about the credit leg a little bit. Yes, so it's a good question. I have talked with a number of people about closing the short legs out when they reach a certain spot, a certain price. I like to do this by setting limit orders. So what do I mean? You have two legs here. You have this long leg and this short leg. And I am a firm believer in having two numbers in your head when you enter any trade. Any trade. Okay, there should be two numbers in your head. First should be, how much am I willing to risk on this trade? If I am wrong on this, how much money am I willing to lose? What is my maximum allowed risk on this? That's the first number you should think about. Most people think about the second one first, and then the one I mentioned, the risk one, second. Most people think, how much can I make on this trade? What's my profit going to be? That's a good number to think about, but it's not the most important one. The most important one is, how much am I going to risk? The next number to think about is, where am I going to take my profits? What I like to do is place limit orders. I place limit orders when I get filled to close my short legs and my long leg. Now, the long leg, again, I might not place that limit order right away, especially on a calendar spread. Because if I'm buying a calendar spread 200 days away, I'm not going to place a limit order for a target. If I paid 10 for this, let's say I want to double up. Let's say I think I can make $10 in premium, right? So let's say I would not go and just place a limit order for 20, right? Just wouldn't. But on that short leg, where we only have 45 days and we sold it for 40 cents, right? That short leg, I would immediately put in an order to buy it back. When you sell this short leg, the type of order is a sell to open. All right, so you've got a buy to open and a sell to open order here. When they get filled, you would want to put in, well, in theory, you could put in, what I like to do is I put in a buy to close order. I'm fairly aggressive. I look at 80 to 90%. I think for people starting out, you should be more conservative, 60, 70%, even 50%, right? And take it off the table then. And once it gets filled, you can go in and sell another one. But that's how I manage my profits. I just let the orders work for me. All right. So let's look at an example. Oops. Normally, this is the picture we want for a long calendar spread. A nice bullish stock, right? That's what we want, a nice bullish stock. So let's go over to here. And Tyson Foods was a company that John Schlitz had mentioned the other week in his morning insights. So let's pull up Tyson Foods. All right, we'll see. Oh, interesting. All right, so we are oversold still. Nice, very bullish stock, strong relative strength. We've got a little bit of a dip on money flow, but we've had really good persistency. That's good. Money flow is down. The stock is also down a good 7-8%. So I don't mind if money flow is a little red when the stock is on a decent pullback. When we go from outside the upper band down to the lower band, and then we see money dip a little red, not too scary to me. So let's say we were interested in maybe taking this out for a way. We thought Tyson was a good longer term play. So we could set up a calendar spread on it. I'm going to set up a couple of them so we can look at the difference between them. So first we're going to buy, let's go to the left. We'll do a shorter calendar spread in terms of duration. So on this one, we'll look at the quarterly. We'll go out to July. We'll even do the shorter one. We'll even look at April. And then we would be selling a call against it for a different time. Let's say this monthly. There you go. Now, that is a regular calendar spread, different expirations, same strikes. I wouldn't necessarily do it in or at the money on these, because what you want in a regular calendar spread is for the price to stay below that strike in that time, and then eventually get above this strike in that amount of time. So what I would rather do is maybe look at the 82 and a halves. All right. So will we stay below 82 and a half in the next 16 days and get above 82 and a half in the next 3 months? That's not a bad calendar spread. Now, that is a typical just calendar spread. A diagonal calendar spread is where we change the legs. So in here, I'm going to turn our regular calendar spread that we created on the left panel, and now we're going to create a calendar spread that's a diagonal using the same expirations. So we went with April and January. And the first leg was 82 and a half for both. And then the one I'm selling, let's make this farther up. We're going to make it an 85, maybe. There you go. All right. Oh, they don't like it as much. But that's a diagonal versus a regular calendar spread. Now, the risk reward appears to be a lot better on this one, and that's true. You're going to get a better risk reward if you can do these. The thing is, I think it's harder to do the regular calendar spreads where you're expecting it to be below a certain price by a short date and above a second price by a different date, which is what you're saying here, but I think it's harder when they're the same price. I think it's easier when you move the short leg up higher. All right. Now, on the diagonal, as I said, I like to keep the trade cost less than the width of my strikes, which we have. All right, 2.5 width, less than 2.5 cost. I don't have the same rule for the regular spreads because they're the same strike. Now, could you roll the short leg? Absolutely. In fact, you should. The idea is that once this, so what I would do personally is if I've got this filled for 10 cents, I would put in an order to buy to close for probably 2 cents. And then buy it back for 2 cents, take my 8 cents, and then I would turn around and I would sell another one for February. Rinse, repeat. All right. That's the idea. We could, in theory, we could see if we get a little more money for the 84s. No. All right. So that's how we do this. Another way to do this is let's look at it on a much longer time frame, which is let's go out and buy the January 18s. So that's a year away, next year. And I think it's easier when you go slightly in the money. We're looking at out of the money one to start. Then here we would sell maybe still sell January. Well, maybe we could sell the February's 87 and a halfs. All right. There you go. Now this is going to cost me 615, and I'm only 5 wide here. So that's not quite what I'd like. I might even go to the 90s on this. Now it's costing me 640, but I'm 7.5 wide on this. I like that. Once these fill, I will go in and I will buy to close, put in a limit, buy to close this short leg for maybe 6 cents. 6 cents would be an 80% profit on that. You could even do it for 10 cents, take 66% profit, and then go from there. All right, and yes, you can roll the short leg. I think that answers those questions. I think it's easier and more profitable to do these. It does cost more if you go deeper in the money. So instead of the 82.5, whoops, we could do maybe the 77.5. Now the cost for this is 880, and look at the width is 12.5. That's really good. I got a lot of room to run before I tap that short leg there. And again, I would still be turning around and buying this back to close it. All right. Of all these, I still like the regular calendar spread the most. In this case, once you get past this date and we start to climb higher than the 82.5, then this almost needs to be a diagonal. What's the general criteria for using the calendar? A regular calendar spread where you're picking the same strike but different expirations, I have different sets of criteria than I'd use for a diagonal. I don't do a lot of these regular calendar spreads. I think that you want to do these slightly out of the money. You want to anticipate where the price is going. So, I mean, if you think that by January 16th, we're going to be past 82.5, that's not the strike to pick. You want to pick a strike here that's going to, where you don't think the price will be by this date. And then if you want to do just a regular calendar spread, you just change this from the match. So if you don't think if you think that we could be at 84 in 2 weeks, then you want to go look at maybe the 84 and then change this to the 84 also. It only has an 85, so then maybe you just want to do the 85s. All right. If that's where you think it's going, that's what you should use. You should use a strike higher than where you think the price is going. Otherwise, you're just going to lose money on this one at a rate that's not going to help you when you're making money on this one. So for a regular calendar spread where you're picking the same strike, those strikes need to be above the target price for where you think the stock will be on the short leg, not where you think the stock will be on the long leg. This number should be greater than where you think it's going to be here. It also should be lower than where you think it's going to be here. How's that sound? All right. On a diagonal calendar spread, I want the premium paid to be less than the width of the strikes on a diagonal. I think you're better off going deeper in the money and doing the diagonals, but a lot of people like to do more aggressive trades like this, and that's fine. You just have to understand your risk and reward. Oh, yes, George. So we want bullish stocks that are positive relative strength, have had good money flow persistency, that are above a rising trend line. So if you'd like, I can send you copies of my slides, but this is the general picture that we want to see. And I'd encourage you to go attend some of our other sessions where we go over that a lot. Tuesdays and Thursdays, Joe does one. We're also starting a swing trading session starting tomorrow at 3 p.m. I'll go over it more there. Oops. All right. So those are long calendar spreads. You can also do long put spreads on the put side. Most people I know don't do the long long put spreads. They don't pick out stocks that they think are going to be bearish for the next year. Generally speaking, they pick out stocks that they think are going to be bullish. Markets tend to go up more than they tend to go down. Again, you want to do this when the implied volatility is pretty low, and you want to manage your profits on both legs, but a little more aggressively on the short legs. All right. So there's calendar spreads. Let's talk a little bit, briefly, about our buddies, the ratio spreads. Ratio spreads are good for short moves, small moves. Okay, so there's the screen I want. In a front ratio spread, this is where you have one long option, typically at the money, and then two short options out of the money. A ratio spread can be any combination. It can be 1 by 2, 1 by 3, 1 by 4, 1 by 5, 2 by 3, 2 by 5, 2 by 7, 2 by 21. 2 by 20 is 1 by 10. Right? It can be any number, 5 by 3. Any time where you don't have the same number of calls short as calls long, it is known as a ratio spread. If you want to do some really complicated trading, we could combine our ratio spreads with our diagonal calendar spreads, and we could buy 2 long and then sell 3 short for different expirations at different prices. Whew. But just the regular ratio spread. I'm going to use 1 by 2 examples for the ratio spreads. So we're buying 1 long, and then we're doing 2 short. When you're doing front ratio spreads, I strongly encourage people to do these for a credit. That is, net, you should be taking in money. The amount of money you take in on the 2 short legs should be more than the money that you get on the 2 long legs. And then again, you want to manage your risk and profits very carefully. So this is a short call example on a front ratio spread where we are buying 1 at the money and then selling 2 out of the money. When we do it for a credit, you see it reduces all of the risk down. Now, there is a lot of risk up, right? Because you have 1 naked option. Because you're selling 2 and only buying 1, you're sitting on 1 naked option, which means that once you get past a certain point, your risk is pretty steep as we go up in price, and it's unlimited. If you do this for a credit, doesn't matter how low we go, you profit. You maximize your profit at the short strikes. All right? So this 245 strike, that is right there. It's at 245. That's where you maximize. Don't play the get the max game. It's not a winner. Okay? Play the I grabbed a good chunk of that profit gain. Awesome. Now, what I like to do is tell people to manage these for half the maximum profits. So you're going to take in $81 right off the bat. You can maximize at 281. That number includes this number. Okay? That 281 includes that 81 in it. So you're going to take an 81 and then you can go up another 200. What I tell people is take 100 out of that extra 200. Take half of it. Or take half of the max. Take 140 out of this. That's a 50% gain. All right? How many of you would like to make a 50% gain in 45 days? Everybody should have their hands up. I can't see you, but I'm picturing everybody here with their hands up because everybody should have their hands up. So don't shoot for the 281. It just, you're only going to get that at expiration. And Yeah, you're only going to get that at expiration if it closes exactly at 2:45 in this example. All right. Let's look at short call example on Tyson. Come on. Oops. All right, so we're buying one at the money. At the money is at about 80 right now. Let's just reset them all. So buy one at the money. Then we need to add another call leg, and we're going to sell two of them out of the money. Say 82 and a half. Look at the score. They really like that. Why? Well, first off, your probability of profit is pretty high because when you do this for a credit, you eliminate one side of price move, which means you've effectively created a 50%, half of the profit, half of the prices, right? All the moves down are covered. So if you have a 50-50 shot of going up or going down, you've just taken away half of that. You don't have to worry about 50% of it. Now you only have to worry about the other half. So they really like this. Again, you maximize if you get to, in this example, the short leg, which is 82 and a half. So you would maximize profit at 82 and a half. The maximum you can make on this is 320. You already took in 70. Half of that's 160. So maybe it goes up another 90 bucks. Take your money. Be happy. You can do that in 44 days. For these sort of trades that you're getting a credit for, one, we want to do it when implied volatility is relatively high. Two, we want to make sure that we are buying these back. Okay, so this is one way to do it, and we want to stay on the short end of the time frame. We could even do these. Let's see what it looks like for the January expirations. Ah, all right. What's the problem here? They're not, this is not a credit-based trade. This is a debit-based trade, which means if it goes down, I lose my 40 bucks. And if it goes up a lot, I don't do so hot either. So if that's the case, what I want to do is tighten it up. I want this to come in for credit. Oop, not quite enough. All right, there, we finally routed that for credit. I've got all of one wide. So if I got to 81, I would be closing this trade in a heartbeat. The whole thing, I would just shut it down. You're taking 20 cents. Your max is 120. That's 60 bucks. If you could make another 40 on this, that'd be the way to go. So that eliminates our risk down. The other way that you could do this is to eliminate your risk up. Right now, this is a bullish stock. This is likely to go higher. If it's likely to go higher, then really the move risk is up. So we could just switch this whole thing around. Now, if you're going to eliminate the risk higher, we want to use puts. All right. Let's see if I can do them with 78s. Oh, not quite enough. All right. The other way to do this is you could take the, instead of at the money, you can go slightly out of the money. So if I just did an 81 by 79, now I get a $5. There we go. If I did the 82, ooh, I got to buy the 80s. Selling 282s. I'm buying one out of the money. Buying one in the money. This is backwards. Sorry, guys. That's what I wanted to do. I wanted to go that way. Oh, they don't have any. There we go. Still not for credit. Son of a gun. That's only a buck wide. I'd rather go a little wider than that if I could. But again, I'm trying to get this routed for a credit. You can see sometimes it's not that easy to do. I want the total cost to me to be a negative number. That way I don't have to worry about it going in one direction. So we'll just do this tight. 78 by 77. Now we've eliminated the risk up. We only have risk if it goes down. We start losing money around 75, 76. All right. So that's somewhere around here. Do we think that the price is likely to be here in 45 days? I doubt it. The other side of it is if it goes up, how much do we lose? We've eliminated our risk higher. So it doesn't matter how high this goes. We're going to make 25 bucks no matter how high it goes. Now, typically, this is a play for a move lower because your profit is currently lower. And this is an advanced strategy. So I don't actually recommend doing it in this particular way. In this case, if you wanted to play a move higher in this stock, then the high probability way to do it for short moves is with the front ratio spreads and calls, how we had it set up the first time. The other way to do it is just use a vertical. Don't use something more complicated when something simple will work. So, all right. What do you do if the stock gaps within the range you're looking at? If it's still within the range and you're profitable, that's a breather, and then you go from there. George, these questions are fantastic questions. We answer a ton of them in our onboard session. So what do you do if it gaps outside of your range? Manage your risk. If it gaps within your range and you still have profit and you're worried that it's going to move out of your range, take what you can. Take what you can. When things start to change on me, when things gap or the relative strength changes, when I no longer feel that it is going to go where I expect it to go in the time I expect it to go, I switch it up. I have no problem shutting down my trade. I have taken trades where I've expected to make 50% on them, and it's moved the wrong way, and then just baselined, or it gapped and then just held at that point. And you can't get stuck. You can't get, as Mark likes to say, you can't let your feet get stuck in the cement. If things change a little bit and you start to get worried about the risk of something changing on you, if the outlook changes and you no longer have the same assessment of it, take either what profits you got and move on, or take whatever losses you got and move on. I have, as I mentioned, I have a risk number and a profit target that I expect to close out of my trade. But I will close before then. Just like you don't have to wait till expiration to get out of your option, you don't have to wait till your profit or risk limit to get out of it. If things change, switch it up, right? So if this were to gap somewhere inside of this range and I still had some profits in it, and I thought that it was going to then fade that gap. So let's say it gaps down and I thought we'd get a little bit of a move higher, then I might hang on. But if it gaps down and the relative strength starts to go negative and things no longer look the same, get out. Exit. All right. So that is a front ratio spread, also known as a short ratio spread. Let's take a look at what are known as back ratio spreads, or also known as debit or long ratio spreads. So a back ratio, so all right, back ratio spread is the opposite of a front ratio spread. So in a front ratio spread, we are looking for small moves, nice manageable profits, right? We're eliminating risk in one direction. It's a high probability strategy where we have the chance to make a little bit more than the credit we take in, which is rare for credit trades, for you to exceed your initial credit taken in. So we actually have a reward here that exceeds our initial credit, but it's one way to do that. But this is not for a big move. If you get a big move, you're in trouble. So these are for smaller front ratio spreads for smaller moves with higher probabilities of success, which means our back ratio spread, which is the person on the other side of this trade, they have the exact opposite goals. In their case, they are selling one at the money and buying two out of the money. This is to take advantage of a big directional move with very little risk. This is a strategy that can be pretty good for playing earnings, right? What you're doing here is you're short an at the money option, and then you're long two out of the money options. Now, the two out of the money options, if you do them far enough out of the money, you could do this for a credit as well, in theory, right? But the two out of the money options give you a really nice pop if it moves in the direction you go, and the one sold at the money offsets that risk, which just means it gives you a little bit better risk reward. Actually, a lot better risk reward. Now you'll see, look at the picture of this. It is the opposite of this picture. See that? See how that flipped? Boom, boom, right? They're the opposite. So in this case, you want this is for big moves, nice pops, big moves. You can do these over longer time frames, unless you're doing it for a credit. If you can figure out how to do this for a credit, which sometimes you can do, then shorter time frames. Debit trades, a little bit longer time frames. Let's look at Tyson for this sort of trade. So in a back ratio spread, we sell one at the money to buy out of the money. So in this case, let's say we buy the 80 and then we would sell, let's say, the 82s, 82 and a halves. Boom. Oops, backwards. There we go. No, 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 no. I was right. I'll go a little bit farther out in time. There we go. Ooh, a little too far out in time. Interesting. So here's one that's for a credit. All right. So this is buying the 80 and selling 285s, which means we really would want a target that's 85 or higher on this, which is a little aggressive. Let's do this. 82 and a half. All right. 80 by 82 and a half. So we're buying right here, and then we're selling two right here with an expectation that the price is going to make a move much higher. Now, you'll see the odds of this are very low, 20% chance, 1 in 5 shot. But you have a fairly low risk for a good reward. You're going to risk 70 to make 320. That's almost a risk 1 to make 5. Right? So we're looking for sort of big bigger moves on this. Options play really doesn't like these because they have very low reward. This one, the risk reward isn't quite good enough, I think, for the probability of profit. But if you're looking to play earnings or things like that, when's earnings coming out on this? February 5th. This expiration is February 16th. Oh, look at that. There's even a February 9th. So if you wanted to, you could play the February 9 earnings on this, sell the 80 at the money. You get a decent amount of premium for that, 37 days out, and then you could buy the 82s maybe. Risk 90 to make 290. They probably don't like that much either. 37 score. But you can take a small risk for a big reward. If you think this is going to gap, let's say you think it would go 5%, which would be $4. There you go. That's not too bad. You're even taking a credit, which means if it gaps down below 80-20, you still make money. You make $20, but you've now eliminated downside risk. You only have risk in this middle section here, and then reward if it really makes a move higher. All right, so not too bad. All right. Those are front ratio spreads. Front ratio spreads, again, we're selling one at the money, and then we're buying two out of the money. Right. And they're known as long or back ratio spreads. Straddles and strangles. I'm going to cover these together. So a long straddle is where we buy a call. We buy a call and a put at the same strike for the same expiration. Right? They call it a straddle because you're kind of straddling both directions. You profit from big moves in either direction, but you lose if it doesn't really make a big move. This is, again, a big move kind of strategy in either direction. So you kind of cover yourself both ways. You want to do long straddles in low implied volatility environments. You can profit simply from the increase in volatility. Now, again, this is a long strategy, so you lose from time decay. Any debit strategy loses in time decay, typically. Almost any debit strategy loses in time decay. There are some situations where that's not true. You do a vertical, your short leg's probably going to decay faster than your long leg, so you might be able to make money that way if it just goes nowhere, but that's not what you get into a vertical. It's for a directional trade, not for a theta play. These are also, if you're playing volatility, fine. Any debit strategy will profit from an increase in volatility, but we just want to make sure that we don't do this in high volatile environments. High volatility environments mean that we're paying up. Bigger moves are expected, which means we need the biggest moves to pay for the bigger moves. All right. A strangle then is just a straddle where we separate the two legs and we put them farther apart. So a straddle, again, same expiration, same strike, different types. We are buying, same expiration, same strike, one call, one put. We make money if it goes really low or really high, and we have this loss triangle right in the middle. A strangle is the same thing, except we just move these strikes out. All right. So again, same expiration, one long call, one long put, same thing we're doing there. We're also looking for big moves, but we're moving them away. Now the strikes are different, right? So instead of 243, I picked 246 and 241. They do not have to be equidistant from current price, although oftentimes that's how people set them up. Let's take a look at Chaikin on this. So on Tyson, let's set up a strangle and a straddle right next to each other. So here we'll do a straddle. So let's just pick 79.5. Can we do that on the Februaries? Nope. So we'll do 80 and 80. All right. There we go. Classic straddle. Buying, same number, same expiration, same strike. One call, one put. In this case, you make money if it gets past one of these numbers. That's what we're looking for. Again, these are more for bigger moves. You have a decent amount of risk. It's going to cost you 580 right off the bat. Now, this is, again, for a big move in either direction. We could do a strangle right next to it. So we're just going to set these farther apart. Oops, wrong way. There we go. Oops, 82.5. All right. So the difference between these two, one is price. Right. The straddle costs more than the strangle because the strangle is farther apart. However, there's a decent difference in probability of profit because of the difference in our break-evens. The break-evens are farther away on the strangle. So less risk, less odds of success, we got to make a bigger move. If we do make a big move, like if we go to 90, the strangle's going to pay more. But if we only make it to like 87, the straddle's going to be the better one. So you have to figure out how far you think this is going to move and what kind of profit risk reward you want for those. Right. So as I said, if it only goes to 87, you make a little more on the straddle than the strangle. It's actually not that big of a difference. All right. So you see, if we make a really big move, the strangle far outpaces the straddle. The smaller the move, the better off we are in the straddle. So if it doesn't quite make it as far, the strangle, if it makes a really big move, the strangle is going to pay us a better risk reward. But we have lower odds of success for that. Now, the other side of this is selling them. And that's if you think something's going to stay within the straddle or strangle range. I don't buy a lot of straddles or strangles. I am more likely to sell them. Now, this is a very risky strategy if you're selling a straddle or strangle naked. Very risky. There's advanced options though, right? Because then you're naked on two sides. So, but let's take a look. You see what the loss, the risk on this is 580. If we just set this up as a credit strategy, so we're taking the February 16 and we're selling a call and a put, both at 80. All right. I wish I could just delete the one in the middle here. In fact, better yet, we'll just put this one next to this one. All right. These are the opposite. These are the exact opposite. One is the buyer, one is the seller. The difference in POP is you add them up equals 100. This is the zero-sum game I was talking about last week. Options are a zero-sum game. So the person that buys the straddle on the left, they need it to make a certain move. The person that sells the straddle here in the middle column, they don't want it to do anything farther than that range right there. That's it. On the straddle, If you're selling them naked, again, you take in a nice big hefty profit, but you start losing money quickly if it gets beyond a certain point. So you can see where your break evens are, and you can get a sense of, do I really want to be in this at what point? These are also strategies. If you are selling a straddle or a strangle, limit to close, buy to close, limit order, put it in, take your profits. You don't have to sit there and watch it. If something changes and it doesn't quite get to your limit and you want to close it early, as I said earlier, by all means, do that. You gotta, when you can, and things change on you, you gotta adapt to it. Anyway, so that's selling a strangle. I sold a straddle. So I sold a straddle. I sold a straddle month or two ago in a stock. And one of the reasons I did it was I got really good premium. It was a high implied volatility environment, so I got really good premium. And I didn't mind if I was going to own another 100 shares if it went down. Right? I wouldn't mind being put the shares. So for that particular stock. All right. And if it went up then too much, then I was in trouble. But I was really hoping that it would not move a whole lot. And if it went down a little bit, that's okay. I would be able to profit over a couple weeks. That was the goal. All right. And I think I ended up getting put the shares, turning around, and then selling calls against it. But you take in a decent premium. Another way to do this with a little higher odds of success is, instead of selling the straddle, sell a strangle. So the call, we want to go higher. The put, we want to go lower. Right? Now, again, you're making a little less money. We're making $200 less in this case, but our odds of success are actually not as much higher as I had hoped for this. And going a shorter duration is not helping me. Well, that's why we tinker with these, to see where the best opportunity is along the chain. Yep, so there you go. I happen to rather sell strangles and straddles. You have better odds of success. You're taking a little bit less money, but you're better odds of success. And if I'm doing credit trades, I like higher odds, lower reward for my credit trades. So, all right, it is 12:30. We've been at this for an hour. I will take the next 10 minutes on any options questions, on anything, and anything options related. Any questions on options, get them out now. I will happily answer them. We'll take 10 minutes to do it. While you're writing in your questions, if you have any, I assume you have some. I'm not that good. You must have some questions. Okay. Once again, I will repeat what I mentioned at the beginning. Next week, there will be no basic options class. We are putting the option series on ice, on hold. It's not going away. It's getting renovated. It's getting revamped and redone. And we will re-release it in a few months once I've had a chance to, put together better slides or change the order of slides and break it up a little bit. So if you want to go back and review, you can do that. By the way, if you want my slides, email us at support@chaikinanalytics.com. Send us an email, say, hey, I'd like the slides. I'm happy to send them to you. Okay. This is canceled. Well, that's not even the right date. I see I didn't bother updating the date because we're canceling these. To find our previous sessions, first in the upper right-hand corner, you go to the little icon. It says Product Resources. Then we go to the Resource Center. It will open up in a new tab. Under the new tab, we want to click on subscriber sessions. Subscriber sessions will take us down here, and then we can view all past recorded sessions. And inside, there is a long list of all of our sessions. These are labeled Options Course Series. This is the last one I did, Class 2. We went for quite a while on that one. We had a little bit of a rough start, tech issue at the front. And then here's Basics 1, and then you can go farther down. There's the last Series 3, last Series 2, so on and so forth. They go back quite a ways. Right? Here's one I did back in October. So you can go back and just look at all of the recorded sessions. Now, yes, we are new year. We are rolling out a bunch of what I think are great stuff for our subscribers. The first thing that we're looking at doing is a new series of subscriber sessions that will be held on the first, second, and third Thursday of every month. The first Thursday of every month will be a swing trading / entries exits. What we did was we listened to what everybody was telling us their biggest issues are. And consistently, which doesn't shock many of us, and I doubt it shocks any of you, we were told that short-term trading, specifically figuring out entries and exits, appropriate entries and exits, are one of people's biggest struggles. So we're going to do a sessions on it. Every first Thursday of the month, I will hold a 30-minute, we're going to try and keep it to 30 minutes. My colleagues tell me I talk too much. This is supposed to be an hour. We're at an hour 3 already. So, that's just who I am. Thank you. And so every first Thursday of the month, swing trading session, 3 to 3:30 p.m. Eastern Time, hosted by probably me most of the time. And if I happen to be sick one day or I'm on vacation, then Joe or one of my other colleagues in client success, who you may have heard on one of the sessions, maybe David, will pick it up. They are overqualified to do that session. So I just happen to draw the short straw. That will be the first Thursday. The second Thursday of the month will be on ETFs. We'll be doing an ETF comparison every second Thursday of the month. The third Thursday of the month will be on finding ideas. We will talk only about how we go about finding ideas for long-term investments, finding ideas for short-term trading. How do I find my ideas? I'll tell you. How does Joe find his? I'll tell you. How does David find his? I'll tell you. I'll tell you right now, the way I find mine is I ask David and Joe. But I'm going to show you how they find theirs on the third Thursday of every month. On the fourth Thursday of every month, there's nothing. We're going to rest. We're going to take a breather. But that's going to be rolled out starting tomorrow. You should get an email, hopefully this afternoon, about it. All right? So I think so too, George. I agree. I think they're exactly, I don't know about the doctor order. I think they're what our subscribers ordered. And one of the things that I really love about working here is they listen to you. So when you wonderful fine folks write emails to us, we take note of them. Right? Now, sometimes we get suggestions like, hey, can you tell me exactly what Apple's going to do in the next 30 minutes? I want to do a quick day trade. We can't do that. But a lot of the stuff that you're asking for, things that we can implement over time, and we are. And this is just another part of that. We heard that you wanted more in-depth theory on options, so we started an option session. We heard that you wanted better on timing, doing a timing session. So that'll be tomorrow. Let me do this. If we're going to have it up, congratulations, 1 year anniversary. Congratulations, Sybil, as my folks would say, Mazel Tov. I had a session on credit spreads. Go watch last week's session that I did on intermediate last week. I cover credit spreads. So on here, the session 2, this one right here, that's going to be on credit spreads. We're going to cover singles and vertical credit spreads. That's on session 2. All right. I got to tell you, in the resources, we have all of these different, all kinds of different stuff, and we're going to add another one. So you're going to see another one pop up soon on here, and it's going to be our Rotating Thursday series. I'm going to post. There's a little chat window. What I'll do now is I'm going to post what I hope is the Zoom. I hope I give you the right one, but I'm going to try and give you the Zoom link for the session that we're going to have tomorrow at 3 o'clock. So just give me a second. All right. That should be the Zoom link for tomorrow at 3 p.m. I hope they don't change it on me. You should be able to go into, I posted it in the chat window, so everybody can go to the chat window and get the Zoom link there. I don't know if I can post it in the Q&A box, but if I can, I will. Give me a second. I'll try that also. Doesn't look like it. All right, so in the Zoom box, in the webinar chat, this is the link right here that we're hopefully going to use tomorrow. And there should be a spot in here sometime later today. We'll have a register link for it, and you can register again for tomorrow. I really appreciate everybody that has been on these sessions, the rotating series. We will pick this up again in a few months. We'll let you know when we do it. It'll be revamped, renewed, refreshed. If you have any additional comments, please do not hesitate to send them to us. Please, please, please email us. Let us know what you'd like to see in the redone, refreshed options education series that we'll be hosting. Again, no session next week. No more option series for a little bit, for a month or 2, or possibly 3. We'll see. And then it's going to come back with vigor and vim and renewed and redone. Hopefully better. Thank you all. Again, this recording will be up and available later this afternoon. The new Thursday series are at 2 p.m. Central, 3 p.m. Eastern, the first, second, and third Thursday of every month. The fourth Thursday and the potential fifth Thursday will not have anything. Just the first, second, and third Thursday of the month. New series on swing trading, entries and exits. First Thursday. Second Thursday, ETF comparisons, everything ETFs. Third Thursday, ideas. How we find ideas using the platform. There are different ways to do it. We'll cover a little bit each time. Thank you all. Happy New Year. And I look forward to working with you over the course of a wonderful 2018.